Now, as far as presentation and disclosure, starting off with disclosure, starting out with presentation, you're going to record a contract asset or a contract liability based upon a comparison of the company's performance versus the customer's performance. And the company's performance is transferring control of the performance obligations, and the customer's performance is making payments. And if the company has outperformed the customer, the company records a contract asset. If the customer's outperformed the company, then the company has a contract liability. Now, one important point to make here is that a receivable is different than a contract asset. You're only going to record a receivable when there's an unconditional right to receive consideration. So just by way of example, a customer becomes unconditionally obligated to pay the entity for equipment after it accepts the equipment. So based upon the guidance in 606, the entity recognizes revenue. Let's say it's going to ship equipment to the customer, and it recognizes revenue when it ships because that's when control of the equipment is transferred to the customer, and when the entity can objectively determine that the equipment has met specifications. So under 606, the company would record a contract asset at that point in time, but it wouldn't record an account receivable. They'd only reclassify that contract asset into a receivable when the customer actually accepts the equipment. So if there's some sort of formal acceptance period, 2 weeks, maybe 14 days or something like that, when acceptance is, when the customer formally notifies you of acceptance, that's when you would reclass from contract asset to receivable. Now, with respect to disclosures, there's a ton of disclosure requirements. Now, even if somehow a company avoids being hit by the measurement or recognition provisions of 606, they're going to be hit by the disclosure requirements. And right now, there's not a lot of disclosure requirements on revenue. But the objective going forward is that they want to provide financial statement users with the information they need to understand what's going on in these transactions, the nature, the amount, and the timing, the uncertainty of revenue and cash flows. So annual and interim disclosures, as you might expect, there's a lot more for annual than there is for interim. Public business entities, there's more disclosures required for public business entities than there are for non-publics, but non-publics still got hit pretty hard in this deal as well. I mentioned, there's not a lot of detail in the disclosure requirements that exist now. That certainly changes under 606. There's going to be detailed quantitative and qualitative information that you've got to disclose, stuff like disaggregated revenue. You've got those contract assets and liabilities I just talked about, and the receivables. You've got to talk about beginning and ending balances and reconciliations, activity, things like that. Any performance obligations in general, you got to describe, what's the general nature of your performance obligation and how much transaction price you've allocated to performance obligations at the end of the reporting period that have not yet been satisfied. And then you got to discuss qualitatively, significant judgments you've used, maybe when, as to when performance obligations are satisfied, which ones you use to estimate the transaction price, which ones you use to allocate the transaction price, things like that. So the big changes. The disaggregated revenue one could even go beyond the segment disclosure requirements for public entities that's required now. So it can be a significant amount of disclosures that get added here. Now, SAB 74, as most people are aware, the SAB 74 disclosure, that's an SEC requirement where you got to disclose the expected impact of any new accounting standards on the financial statements once you adopt them. So you got to describe the new guidance at a high level, when it's going to be effective, what's the adoption date, can you adopt early, do you plan to, or do you know if you plan to, things like that. You've got to also disclose the transition methods. In this case, it would be full retrospective or modified retrospective. And if you got to describe which one you expect to use, and also whether you plan to apply any of the practical expedients to transition that we'll cover in a moment here. Continuing on one more slide on SAB 74, one point to make here is that as you get closer and closer to the effective date, this one had a delayed effective date. As you get closer to the effective date, it becomes more difficult to continue to say we've not yet, we haven't yet started to determine the impact. So you would expect kind of that the nature of the information you're providing in the SAB 74 disclosures, that should progress as the implementation of the standard progresses. So you got a public business entity with the calendar year end, you're going to have to apply this in the first quarter of 2018. It's not that far off. So it's going to become harder and harder to justify saying in these SAB 74 disclosures that the impact's not known or can't be reasonably estimated.